Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio, soon to be rebranded as Financial Poise Radio. I am Christopher Cahill. In a few, we'll be speaking again with Nick Veronis and Kunal Shah. The second part of our two-part interview covers private equity. This part will be focusing on the mechanics of the investing and how the money gets made and so forth. So I hope you'll enjoy that. But first, let's go to Yorkshire for some creative destruction. In the middle of December, in Yorkshire, the last deep coal mine in the United Kingdom was closed. It will soon be covered with cement and redeveloped as something else. No more deep coal mines will be operated in the United Kingdom. The location is Nottingley in Yorkshire. The name of the mine, the Kellingley Colliery. That's the last one. Mind you, in 1915, so 101 years ago, there were 2,581 deep mines producing coal in the United Kingdom. There were 1.16 million miners in Britain in 1922. That was the highest of any year. In 1913, 292 million metric tons were produced from deep mines in the UK. And the total was always above 200 million through the middle of World War II. Now that number by 1970 had dwindled to 135 million, and that number as of 2016 is 0. It was a great big institution that has simply disappeared. The people of Nottingley tried to go out in style. I think they succeeded. There was a procession from the town hall to a local miners' club. The procession was led by a Grim Reaper and the Nottingley Silver Band. More about colliery bands in a few minutes. It wasn't a happy occasion, though. It was a sad occasion for a lot of people, even an angry occasion. 2 marchers were reported to have set fire to banners with the slogans UDM Scabbing Bastards or Save Fuel, Burn a Tory Scab on the slogans. Those details I just gave you are from the To the Left Guardian newspaper, December 19, 2015. The statistics I mentioned earlier are from the December 17th Daily Mail. But more from the Guardian. I really try to read papers of different ideological viewpoints on issues like this. Anyway, from The Guardian, Chris Kitchen, the General Secretary of the National Union of Mine Workers, said, and I quote, "I am sure people will argue not burning coal is better for the environment, but as far as I am concerned, this is another vindictive act." Daily Mail reports that through the 1950s, British coal met between 75 and 80% of the United Kingdom's power needs. Then there were closures that seized the industry in the 60s, 70s, 80s, and so on. The Wall Street Journal, in an article published on December 14, 2015, provides 2 charts, and one of them, there's a trend downward, and one of them a trend upward. Before I talk about the data in the charts, where is Britain going to get its coal now? Well, it's going to be shipped in from overseas. So there's plenty of coal in the UK, but it's not going to come out of the ground. It's going to be shipped to them from other places. The tables in the Wall Street Journal show that in 1970, British deep mines produced 135 million metric tons, and there's a very steep slope downward as we come toward about 15 million at the turn of the century metric tons, down to 0 as of 2016. The other chart is the amount of coal imports. In 1970, Britain was importing nothing. They were importing no coal. And as of 2015, 2016, approximately 50 million. There you go. The usage of coal in the UK by the 70s had diminished well below the 200 plus level of the immediate post-war and World War II era. Now is at 50 million rather than a figure 4 times that size. Obviously, other things like nuclear power and gas have taken over where coal used to provide the power in the country. So creative destruction or public policy, things have changed. And the economics of coal require, evidently, that there be no more mined in the UK. Leaving that aside, let's get back to that silver band that was part of the procession, because all of this reminded me of a very fine movie from 1996 called Brassed Off of a Brass Colliery Band. The actual band playing is a distinguished colliery band called Grimethorpe, after the town in Yorkshire from which the band members hailed. Brassed Off, as I said, was in 1996, and maybe everything I've said has gripped you enough to go see the film, but I can also add that Ewan McGregor's in it, Tara Fitzgerald is in it, playing a flugelhorn, Pete Postlethwaite, the late and great Pete Postlethwaite, and Jim Carter, who has lately been Mr. Carson in Downton Abbey, plays a euphonium in the movie. And after the Pete Postlethwaite character is taken down with a coal-related disorder, Jim Carter leads the band in its climactic Royal Albert Hall performance as part of the National Brass Band Championship competition, where they play the William Tell Overture. It's very thrilling. Earlier in the movie, they play the Concierto de Aranjuez by Joaquin Rodrigo. It's a beautiful performance, of course, by the Grimethorpe Brass Band, and I heartily recommend it to you, available on YouTube. So the Grimethorpe Colliery Band continued its success. It won the national title in 92, 2006, and 2007, among many other awards and distinctions. In 2015, in an article in the BBC publication, online publication, dated October 9th, 2015, the actual leader of the Grimethorpe Band, who plays the euphonium, just as Jim Carter did in the film, this man's name is Michael Todd, was asked about the movie, and he said Brassed Off was quite raw to him, having lived through those years. He said that losing the mind, quote, ripped the heart out of the area, end quote. But he had to allow that in the years since there's been a great regeneration, a great amount of commercial development, and Grimethorpe is, quote, on the way up. Let's move from creative destruction then, if that's what happened, and regeneration, to creative authoritarianism. Egyptian tycoon Naguib Sawiris made a lot of money. Well, of course he made a lot of money because he was born into one of the families that, with the army in Egypt, own everything. It's not exactly a free market society, although it has free market elements to it. Anyway, he's used his wealth and his family's wealth to build a global telecommunications empire. This global telecommunications empire, however, operates in the following countries, all authoritarian, with one possible exception: North Korea, Zimbabwe, Tunisia, Algeria, Iraq, Pakistan, and Egypt. Well, maybe Iraq is another possible exception. But along with Tunisia, which is the sole Arab Spring country which still has the whiff of April or May, but the rest of these are straight up authoritarian, or in the case of North Korea and Zimbabwe, in the competition for the most politically depraved nations in the world. So one might say that Mr. Sawiris is an edgy emerging markets investor. Certainly committed a lot of capital to emerging. We'd have to call this raw emerging markets, because these are tough places. He's made a lot of money doing it. The North Korean investment paid off to the tune of $250 million in 2014, before taxes and depreciation. And now I am quoting from a Wall Street Journal article dated January 2 and 3, 2016, entitled Tycoon Jilted in North Korea Because the Story Doesn't End Well as far as that investment. He made $250 million in 2014, but all of that is coming back in a way. Let me read you a paragraph. But in the past few years, a state-run competitor emerged in North Korea, and Cairo-based Orascom hit problems trying to repatriate profits. Orascom said in a November filing in Egypt that it had lost control of its 75% owned North Korean venture, Korealink, and struck the venture from its balance sheet, removing hundreds of millions of dollars in assets. By the way, includes at least $680 million in cash. So that's North Korea. You might say, lie down with dogs, wake up with fleas. But you could also say that an emerging market carries a greater peril than a developed market, certainly, with respect to the repatriation of money. Laws change in such places as the regime begins to feel perhaps threatened. That's just among the risks one might have. The rewards might be quite handsome. Let's turn finally to oil, because we talked about oil last time. Harold Hamm, the owner of substantially all of Continental Resources, a company that has extracted a great deal of oil from the Bakken Reserve in North Dakota, among other places, made a prediction, stout prediction, that oil, which is roughly $30 per barrel as of the prediction time, which is in the second half of January 2016, that oil was going to double in price by the end of the year and be $60 a barrel. The futures markets were predicting that in December 2016, the price would be $38 a barrel. Remember, Harold Hamm argued that this price would go up to 60 because so much drilling has been taken off the table. And when you stop the extraction process, take things offline the way it is being done in the industry in the United States, you are setting yourself up for genuine shortages because it's so hard to get them back online. It takes a lot of time. So between the actual shortages and the prediction of future shortages, prices should, as he put it, double in the year starting in January 2016. Well, in the week since we discussed this, the futures price has gone from 38 to 41. The current per barrel price has gone from 30 to 33. And some people say it's because of concerns over supply cuts. So either Mr. Hamm made the news and made market move, or others are coming to his kind of wisdom late. It's only January, a lot can happen. And I commend to you a written interview, which appears on accreditedinvestormarkets.com or AIMkts.com, which can be accessed through putting that in your URL or through financialpoise.com. Anyway, it's a question and answer with Jason Stevens of Sprott Global. And Mr. Stevens discusses in a concise manner the various factors that go into the pricing of oil. So that might be a good place to start as you think about what to do about whatever oil investments you have or may have. Now let's get to the interview. We have with us again Nick Veronis and Kunal Shah. They are both from iCapital Network. Nick Veronis is co-founder and managing partner, and he oversees the company's private access fund infrastructure and origination. Mr. Shah is the senior vice president of fund manager due diligence and origination at iCapital Network. Last time, we were looking at more of what I called a 1,000 kilometer up view of private equity within the context of private investment generally, different strategies that one private equity manager could use, and the kinds of returns private equity has generated over the last couple of decades, among other things. But today we're going to look a little more closely at how private equity funds themselves function to help educate an investor on exactly what is going on here and how it is money gets from the investor to the private equity fund and then back to the investor in a larger amount, we hope. So, Kunal, how does a private equity fund work? Can you provide us with an overview of the key participants with an emphasis on when do investors get paid and how much do they get? And when do investors sometimes have to pay things like capital calls?
Yeah. So a typical private equity fund is a closed-end vehicle which is managed by an investment manager or a general partner, as Nick earlier said, and a limited partner, which is a collection of investors that consist of pensions, endowments, insurance companies, and sometimes high net worth individuals as well. In a typical private equity fund, the fund manager will go out to investors and collect a commitment from investors, meaning they are good for the 10-year period to fund underlying investments whenever the manager calls capital. In private equity, the capital is not drawn down on day one. So when you buy a stock in a public market, you have to invest whatever you want to buy on that day. In private equity, oftentimes everything is a commitment. Think of it as a line of credit that you can draw upon during a period of time that is in the agreement. Oftentimes, capital gets drawn over a 4 to 5 year period, where majority of the capital gets drawn over the first 2 or 3 years as private equity funds continue to make investments. And then towards the end of the 4th to 5th period, the investment activity slows down, the investment period is over, and private equity manager is involved in harvesting the portfolio. When I say investment period, every private equity fund has a term in its agreement with the investors where they can deploy capital during the first 4 to 5 years. Oftentimes, the 5 year is a typical investment period, and the remaining 5 years are called harvesting period, where they are helping underlying companies grow, add value to underlying companies, and then sell those companies at an appropriate time. Traditionally, the investment, the distribution should start coming back starting year 4, year 5, normally peaks around year 5, year 6, and, no private equity, there's no guarantee associated with investment in private equity, but by year 7, year 8, investors should get 100% of the capital back, and then from there on, they start receiving their profits, essentially, on the investment. But even though the years I mentioned is year 7, year 8, doesn't mean that your money is locked up for year 7, year 8, because remember, 100% of the capital doesn't get called down on day one. So if you do the weighted average of when the capital was drawn down and then your money was returned back to you, the average is around 5 years in our view, which is a typical holding period for a private equity company.
Okay, so that's, again, to go back to our prior program, there's limited liquidity in private equity. But to underscore your point, if you make a $250,000 commitment, you're not writing a check on day one. You're writing it in dribs and drabs over a period of time, as is needed by the fund manager.
That is correct.
Well, Nick, tell us then how private equity fund investment by an individual might fit into an individual investor's portfolio. After all, a portfolio is there, some say, to manage downside risk and provide appropriate upside returns with offsetting risks across the portfolio. So how would it fit in, and what are the typical minimums for investing in private equity funds?
Sure, Chris. So for qualified purchasers, we and it really depends on obviously the investor's profile, including their age and other factors, but a lot of sophisticated wealthy investors target between 5 and 10% as the allocation in their portfolio, and an increasing number of families, wealth advisors, individual QPs are looking at private equity not as an isolated, opaque asset class, but something that really belongs as a core component in their overall portfolio. Just to give some perspective, if you look at U.S. endowments on average, and this was a survey that was done, I think, just last year, fairly recent, but a 15% allocation was the average for U.S. endowments. The top 10 endowments had an average allocation of, I believe, 21%. The top 200 public pension plans had a 9.3% allocation, and the top 40 U.S. wealth managers had a 3.3% allocation. So when we look at it, and there's been lots of conversations, particularly within our network over the last several months, about the endowment model. There was a recent Bloomberg article that essentially had the league tables for the endowments through June 30 of this year. And not surprising, at least to us, David Swenson, the CIO of Yale, and his disciples, people who work for him, who are now the CIOs of Bowdoin, Princeton, MIT, they really led the league tables with returns of, I think it was 11.5% to almost 15%, compared to 3.5% for the S&P 500. So a lot of people are looking at that model, and what those CIOs have in common is a very high allocation to PE. By the way, higher than an individual or a family would have. In Yale's case, I think it was 30 to 35%. I think it was 35%, in fact, maybe going down to 31. But very high allocations to private equity. But the key really is those institutions and those CIOs are very good at picking fund managers. So one other thing to think about, age is important. As we talked about earlier, this is these are 10-year lockups, so fairly liquid. Somebody's in their 70s may not be appropriate unless they're doing it for estate planning purposes, and that's really how they should sort of think about it. You asked about the typical minimums. Minimums in private equity, and these are minimum commitments, can be $5 million. Typically, that's kind of on the low end. They could be $10 million, $15, even $20 million. Through different vehicles, for example, an iCapital private access fund, individuals can access leading established managers for as little as $100,000. So again, we're trying to make private equity a lot more accessible to the high net worth individual.
All right. Well, Nick, just to keep our terminology straight here, I should say that I'm myself a restructuring attorney, so it's natural to me to think in terms of limited partnerships and general partnerships. But for non-specialists, and limited partnership includes GP and many LPs. The GP runs the show. The LPs are the investors in the context of private equity. So the GP is the same thing as the fund manager. Okay, fine. Fees are paid to the GP, which affects the return to the LPs. So Nick, can you explain the fee structure for private equity funds? What's being paid to the fund manager GP and under what circumstances?
Sure. So private equity managers charge, and these are the GPs, as you said, but they charge their investors an annual management fee, typically in the range of 1.5 to 2% of the capital that the investor commits. And that goes to support the salaries of the investment team, due diligence expenses, and ongoing portfolio company monitoring. So private equity is highly labor intensive, especially when compared to traditional mutual fund investing, for example. So, traditional public equity managers create portfolios of public stocks that they believe will outperform their benchmarks. But unlike private equity managers, they don't actively work with the management teams of the public companies to improve the performance. Value creation in private equity begins with deal sourcing and due diligence. It can take years to build a relationship with a private company management team before investing. At the very least, you're usually looking at 4 to 6 months of conducting deep due diligence and negotiating an investment. And PE managers sometimes come through 100 deals or more to find an attractive target. And once they've invested, the private equity managers create value through a combination of usually three things: financial engineering, optimizing the capital structure through leverage, through debt; multiple expansion, so for example, buying at 6 or 7 times EBITDA and selling at 8 or 9 times EBITDA. And then third, and this is where they're creating real alpha, is implementing growth strategies, instituting operational improvements, doing roll-ups, and that's creating value during their hold period. So revenue's increasing, operating earnings are increasing. So it's very hands-on. Private equity managers are often speaking with their management teams of their portfolio companies on a weekly, sometimes daily basis. In addition, the managers collect performance fees. So this is the other part of the equation. It's known as carried interest, which is 20% of any value appreciation they create. Most managers have a return hurdle that they have to hit. It's known as a preferred return before they can take their carried interest. So that's the minimum annual return that their LPs, their limited partners or investors, are entitled to before the GP can begin receiving carry. And typical hurdle rates are around 8%.
Fund manager selects portfolio company opportunities and then invests the cash in the PE fund, or the cash you can get from commitments, helps run or reshape the portfolio companies. They increase in value, and this generates, again, cash coming into the PE fund, which then gets distributed a certain way, some of it in management fees, which are simply paying for the work, and some of it in what is called carried interest to the GP, but only if the LPs, the investors in the private equity fund itself, get 8% or so, whatever the arrangement is, first. Then the private equity fund manager gets these, what people sometimes think are outsized returns, but it comes at the end of this process. Is that a fair enough discussion?
It is, Chris. That's accurate. And the other thing that I left out was that private equity managers invest alongside their investors. So they're committing their own capital alongside their investors, or putting skin in the game, which is important. And I think that's also a key differentiator in the private equity model. So interests are aligned between the investors, the fund manager, and the underlying management teams of their portfolio companies who have management incentive programs in place. So everybody in that continuum, the portfolio company managers, the fund managers, and the investors are all aligned to generate profits.
Kunal, please, we spoke about this in the last segment, but could you speak about it again? Context for the fees GP might get in relation to the performance of the fund itself. Just to repeat perhaps what we said, but it's worth repeating because of the key nature of the fund manager. How does his or her expertise figure into this?
Yeah, so what we try to tell our investors that the way you should view private equity performance is forget the headline number of 2 and 20 and focus on the net returns, because the net returns, when you compare that to public equities, are substantially larger than what you will get somewhere else. So there is a higher cost of investing in private equity, but there is a higher return expectation from the asset class as well. And when you look at the historical data, private equity has continued to generate an outsized return. As far as the quality of manager, the fund manager's expertise, that doesn't really change. For the vast majority of the market, the carried interest stays around 20%, and the management fee stays around 2%. There are certain strategies, such as private debt strategies, or certain real estate strategies, where the management fees drop to 1.5%. And there are certain strategies in the venture capital space, especially early stage venture capital space, where you're investing with well-known venture capitalists out of Silicon Valley. The carried interest is 30%. But I would say that the 30% carried interest or 1.5% management fee are rare. The vast majority of the market charges 2 and 20, which is the headline number. But again, when you put the context around, looking at the returns, when you're getting 300 to 500 basis points after accounting for those fees from the asset class over public equity markets, that's a price worthy of paying in our view, because not only it brings you a high return, it diversifies your portfolio, and it reduces volatility in the portfolio, because private equity tends to be fairly more stable because it's only marked on a quarterly basis.
All right, well, let's talk about a liquidity and timeline. Nick? In our last program, I think we were talking about 4 and 5 year timelines. So the investor puts out a commitment for $1 million. And at what point will it receive all that it's going to get from a typical timeline? And how much do these timelines vary?
So, Chris, they vary quite a bit. It's kind of hard to talk about a typical timeline, but in general, private equity funds have a 5-year investment period, and then they essentially go into harvest mode. So then they start, they're just focused on exiting their investments. Investors commit to their total fund investment up front, called a capital commitment, so the GP then deploys over that 5-year investment period. In some cases, it can be shorter. It can be 3 years. And in some cases, it can be a little bit longer. And again, once the period is over, the GP, sometimes the 10-year life, so 5 years to invest, 5 years to harvest, will have an additional year or two, sort of extra innings. But the investor can expect to receive distributions from their invested capital. And this is where there can be a wide range, but they can start receiving distributions in year 3. In some cases, they can receive them in the second year. But usually years 3 to 5, they'll begin receiving distributions, and then the distributions will accelerate. So the way I would think about it is you make your commitment. That commitment is drawn down during that 5 years. So as the underlying fund managers invest in portfolio companies, they send out capital calls. So you may make a $1 million commitment, and then that commitment is drawn down typically over sort of 3 to 3.5 years in. Usually about 70% of that commitment is called down, and again, it's called down You might get 6 to 8 call downs per year, and then you begin to receive your invested capital back. When you hit your kind of break-even point, when you get all your bait back, it really varies, but you might get your bait back in sort of years 6 and 7, and then you're kind of in, then at that point, everything is upside or gravy. So for people who want to build exposure into private equity, may have a very small or no allocation today, if they come into every vintage, they don't try and vintage pick, and they want to stair step their way up to 5, 6, 7%, they can do that over a number of years. And eventually, when they level out the program, if they reinvest the distributions, can potentially become self-funding. Kunal, I don't know if you have anything to add to that.
There are countless examples of this in the institutional world, and again, I know we are talking to a mostly high net worth community here, but there are similarities about how to build portfolios in high net worth community to institutional world. There are countless examples in institutional world where you have seen a well-constructed portfolio become self-funding by the time it hits year 6, year 7, because the distributions you receive from the earlier investments, call it vintage, as Nick said, will start giving you money by year 5, year 6, so that you can start funding some of the capital call obligations through that, such that the cash drag out of your own pocket is going to be lower than what you had expected. So to Nick's point, if you construct a evergreen every year vintage year program where you invest in private equity and continue to sort of just make sure that you get a good quality manager and good roster of manager, you should be able to create a self-sustaining and self-funding program by year 7, year 8.
Oh. And Chris, the last thing I would add is that very early in a fund life, years 1, 2, 3, when the GP or the fund manager has identified investments and they're sending out the capital calls that we referred to a moment ago. There's something called the J curve, where private equity funds experience negative returns for the first 2, possibly 3 years as a result of capital calls to make the investments and few, if any, exits. So again, you're in that investment mode and you really haven't begun to harvest yet.
All right, well, let's say you're at a certain early point in the J curve, and the investor, the LP owner, the owner of the limited partnership interest, decides that it no longer wants to do this with this fund manager perhaps, or maybe there are concerns personal to the investor, the limited partnership interest holder, and decides it would like to transfer its limited part interest to somebody else. Can they do that?
Yes, absolutely. So there's a strategy within private equity that has emerged, has become more popular in the last 5 to 10 years. It's called secondary strategy. In this strategy, essentially, there are fund managers similar to a buyout manager or venture capital manager. There are fund managers whose business is to buy interest from investors who are looking to get out of a private equity fund, and they will have information on underlying portfolio of a private equity fund manager. They will underwrite that. They will do their own analysis of what the future outcome of the portfolio would look like, and they'll give you a price based on what their expectation of the portfolio will be. So this strategy has gotten very popular, has gotten much larger as well as a result of that in the last 5 to 10 years. And again, institutional investors are constantly using this as a portfolio allocation tool, where oftentimes the CIOs of the portfolio changes and they change the direction of the investment portfolio, and they say they don't want to invest heavily in, let's say, emerging markets private equity, and they want to sell some of those positions. That's where the secondary manager will step in, similar to the scenarios that you provided, that there could be a personal situation in an investor's life and they want to get the cash out. They could pursue a sale through a secondary market. I should point out that the secondary market is private. This is not something you sell on a public market, but there are many managers that have emerged in this space that can give you a price within a moment of few days, if not weeks.
Yeah, Chris, it's important to note, though, that secondary buyers in private equity are obviously looking to make a profit. So they're purchasing these interests at a discount to the net asset value. So if you exit early and you can find a marketplace through going to secondary providers, you should expect to take a haircut on the NAV of your fund investment. And also for individual investors with smaller bite sizes, that market is I would say less open, harder to sell smaller pieces.
Well, all right. Speaking of small and large, here's a question that I've seen and would like to ask either one of you, although I guess Kunal is the due diligence maven. So if you're an individual investor with 100,000 or $1 million in some extremely large private equity fund, CalPERS is in the fund in a meaningful way. You've mentioned CalPERS on our last show. They're one of the largest institutional investors, but they do this all the time, and they have a large position in this private equity fund. So if CalPERS is doing it, and they have all the due diligence capabilities in the world, why should the individual investor give a second thought? Isn't the necessary due diligence covered by the institutional investors?
There are a couple of factors here. So first of all, you don't want to rely on somebody else's due diligence. So from a fiduciary perspective, from your own sort of personal interest perspective, you don't want to rely on somebody else's due diligence. You can look at those investments. You can make some opinions of who else is in the company of the investment with you. But that's the first thing I would say is, if I'm investing my own money, I'm not just going to just invest based on somebody else is investing in. Second, if you're following CalPERS' footsteps, you don't have the access to the diligence report that they may have written, or they may have sort of bought it from a consultant, right? So you know that they're investing in the X, Y, and Z fund, but you don't know what are the reasons they're investing in. Their investment return profile could be very different from your investment return profile. They might be investing in for growth, whereas your number one focus is defensive. So you don't want to invest in a growth sector. The final piece I would say is that, CalPERS, they have been doing this for a long period of time, is much more sophisticated. They have the access to information. They have been knowing who is good and who is not. You, again, have not been, as an individual investor, do not have access to the same level of data that CalPERS has, and CalPERS is not going to share the data with you. So there are multiple factors like that where you just don't want to follow somebody else's footsteps. That information is very helpful in terms of understanding who is going to invest in the fund and what company you are going to be in.
Relevant but not conclusive, we would say in the law. Whether CalPERS investing is something that should help you decide to invest there is relevant but not conclusive. Well, Nick, since fund managers and the quality of funds themselves on an individual basis matter so much, what are some of the qualities investors should look at in a fund when analyzing the opportunity to buy a limited partnership in it? And what sorts of due diligence specifically might a semi-sophisticated or less sophisticated investor want to keep an eye out for?
So again, Chris, you want to look at how did that fund manager, when you create value in their last fund, and obviously you want to look at that once you've seen, their historical track record. So you start with the track record. If the track record is interesting to you, if it's impressive, then you want to take a look at how did they do that, and for how long, by the way, have they been delivering strong results. So again, there's usually three ways, and it's usually a combination of these three things that fund managers do to create value. One is multiple expansion. Again, buying at 5 to 7 times EBITDA, selling maybe at 8 or 9 times EBITDA. The other is financial engineering. It's putting leverage on companies. And then the third is during their hold period, the underlying companies perform better. Revenue goes up, EBITDA goes up, and the manager has a hand in that. So that's evidence that the manager, A, made a smart investment, but B, maybe helped create value along the way by working closely with underlying company. So you want to analyze how did they create value. From there, you want to look at things like loss ratios. Was their portfolio kind of hit-driven? Were they just in a hot sector or a hot geography at the right time? Did they really create alpha? You want to look at succession issues. Is the team and the senior individuals, investment professionals who delivered that value, are they still at the firm? Are they still hungry? Do they have fire in the belly? Have they made a lot of money? But succession is an important thing to look at, and performance attribution. Who in the firm was responsible for delivering those prior results? And then there's lots of other things that you look at when you're doing due diligence. We do a very deep dive where we're looking at performance by sector, by geography, doing a dispersion analysis. So when we do due diligence, it always involves an on-site. We go visit the manager. We spend 4 or 5 hours with the manager. We do lots of follow-up reference calls. But doing due diligence is very important in private equity. Again, it's not rocket science, but it's very labor intensive. It can take a team a month to complete diligence on a manager. I don't know, Kunal, if you have anything to add to that.
No, I think Nick covered a lot of that. I think I would emphasize just the fact that you need to invest with teams who are hungry. Private equity is a very entrepreneurial asset class. It's an asset class where a group of late 30s, early 40s executives who have built a career on Wall Street doing investment banking or consulting had the deal flow and now have the fire in their belly to go out and find those companies and invest in them and help those companies grow. That's a very, very labor-intensive process, and you need to be in that game for multiple years. As we have discussed several times, this is a 10-year asset class. Often the investment horizon is 5 years. You need to be in that for 5 years, and sometimes there are positives and negatives of that. It's tax on your personal life as well. And so that's why it's very important to identify managers who are hungry enough and are focused on the strategy and execution for 5 to 10 years.
All right. We've been talking in general, and I think very informatively, I appreciate it, fellows, about private equity. But let's think about the individual investor, high net worth individual, but not an investment professional. Let's say a radiologist who's done very well and is now in her middle 40s and maybe owns a couple of entities, but is not a sophisticated investor. I can imagine such a person then being confronted with simply the documentary demands of investing in PE funds and thinking, I need help with this. How does iCapital help such people?
So, Chris, the first thing we do is we provide that high net worth individual with online access to our due diligence report. We provide access to the underlying fund manager's investment presentation so that they can better understand, the story, the manager's experience, and their track record. We also have what we call a video roadshow. So we have a 1,000 square foot video studio in our office, and the managers come in and they tell their story. And we know nobody wants to look at a talking head for 20, 30, 40 minutes. So we kind of break it up into 3 to 5 minute, very digestible video chapters where the manager talks about in one chapter his or her track record. They'll give a firm overview. They'll talk about the individuals at the firm. They'll talk about their strategy. They may give a case study, and they'll talk about the current market environment and also the competitive landscape. So the individual investor can come to iCapital and they can hear the manager tell their story firsthand, and they can also, we ask them, we usually give them a page and a half of diligence questions. So there's value add there too because they answer the questions that an institutional investor might ask. And then in terms of processing a commitment, once they do their work, our system is very easy in terms of they fill out their information when they're onboarded through an online suitability questionnaire. And then when they start filling out a subscription document, it kind of pre-populates with their information, and then there's an electronic signature. So it's very easy to come in and do your due diligence, do your homework, select a fund, make an investment, and then we have ongoing reporting and administration that's also very, very transparent. And the workflows that we've built are very intuitive. So it should be relatively easy for the investor to track the performance of their investment on a quarterly basis. Kunal, I don't know if you have anything to add to that.
No, the only thing I would add is that we also are very education focused as a company. And I think we mentioned earlier in the earlier session is that we have an online university concept here, but we do a lot of educational series. We host webinars, we host sort of events that are catered towards educating the high net worth community, a radiologist or a lawyer to understand what private equity is and how to invest in private equity. So one of the benefits of being part of our sort of network is you also learn how to invest in private equity before you actually invest in private equity. And I think that's another value add that we bring to the table.
Well, all right, then I have to ask, where does iCapital fit in the compensation and participation structure of PE funds? We talked about how the fund manager gets its cut and how it's composed and how that has an impact, but perhaps not a decisive impact on net return. But iCapital has its own bills to pay, and it's a profit-making business. How does it get paid?
So at iCapital, we charge a fee. We think it's a very modest fee. It's below what we've seen anywhere else, either through fund of funds, through the large global private banks or wirehouses, or other channels into private equity. So it's an annual management and administration fee for the vehicles. Again, it's quite low. We charge no carried interest, so there's no quote unquote profit leakage through iCapital. We're not participating in any of the value appreciation of the underlying funds that's passed on to the investors. So we think our fee structure is the most efficient, I think, that we've come across in the industry.
Well, all right.
Yeah, and I think that is, what you get is, I always say to investors, is not only the fees are lower, but the transparency is significantly higher as well. So when you marry the two, it's a win-win scenario for the investors because you educate yourself, you know the reasons why to invest in private equity, and then on top of it, you get fees that are lower than anybody else you will find in the market.
Well, all right. Well, thank you, Nick Veronis and Kunal Shah of iCapital Network. It's been a pleasure having you on the program for both segments.
Thank you, Chris. We very much appreciate you having us on. It's been a pleasure.
Thanks for having us, Chris. It was great.
All right. You've been listening to Accredited Investor Markets Radio. I am Christopher Cahill. Accredited Investor Markets Radio is produced by Stephanie Straight. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.